Hi, Will Shao here, real estate agent in the Greater Boston area. Today I have Jason.
How's it going?
He's a lender with Model Mortgage. So today we're just going to talk about your role as a lender in the real estate process. I tell my clients who are looking to buy a house, the analogy I use is that we're entering like a relay race, and we're going to be working with three professionals: your agent, your lender, and your real estate attorney. So today we'll talk about the lender's role in the real estate process.
Absolutely, and that's a great analogy to use for the process because it really is a lot like a relay race, and that kind of handoff between one point and the next. The role of a lender ideally is going to start before the client even finds the house. Starting with that pre-approval process, doing a really good, thorough job on the front end to make sure we give them a good, solid pre-approval, and then kind of guiding them through the process. In the old days, it used to just be giving a client a pre-approval letter and say, hey, give me a call when you find a house. Let me know what happens. And, the shortness of inventory we had during the pandemic really changed that because it forced a lot of us, at least myself, to take a more active role in being in that buyer's corner in terms of, when they made an offer, proactively reaching out to the listing agent, letting them know how solid the pre-approval was and, certainty of transaction, stuff like that. So our role in the process, I think, has deepened a lot and gotten a little bit more significant. And, once we get under contract and we've got a property, then it's really guiding the client through the process, educating them on the different loan options, fixed rate, adjustable, conventional, government, and really making sure they understand all those options so they can make an educated decision on what's going to best serve their needs, their situations, and their priorities.
Yeah, that makes sense. So let's break that down a little bit. Let's talk about pre-approval because that is definitely the first step. Whenever someone approaches me and tells me, hey, Will, I want to buy a house, I always say, go to a lender like Jason, get a pre-approval, find out how much you can afford. So let's talk about what that's like. If someone calls you and says, Jason, I need a pre-approval, what does that process look like?
Yeah, and again, this is, I will say, one of the most important parts of the process and one of the parts that, unfortunately, I see a lot of buyers get wrong and make mistakes here because they wait too long to get this done. And I get it. A financial colonoscopy is not the most fun thing, and not everyone goes out of their way to have one of these. But understand it's a necessary part of the process, and the end result is going to be a better understanding of where you stand and what your options are going to be. When we start that process, it's about understanding the client, what they want out of a property, not just from a bedroom count standpoint or where it's going to be, but what they can afford payment-wise. It's one thing for them to tell me, here's what I make, and I spit out a number and go, oh, hey, your debt-to-income ratio says you qualify for this much. I want to know what they're comfortable with on a personal level. I want to understand from them what their expectations are and how a mortgage is going to fit to their budget on a human level and understand that. So that's really the first part of the process. Then it's evaluating their credit, looking at their income, looking at their assets, and putting them in a position to, have a better understanding of how the mortgage is going to fit into their lives and replace, their rent or whatever their current housing situation is.
Okay, sounds great. All right, so after the pre-approval process, let's say the client goes out shopping, we find a home together, we get it under contract. Usually after that point, I'll hand it off to Jason, and Jason, you'll go through the rest of the financing process. So how does that start? What does that look like?
Sure. The good thing is we've already kind of, hopefully, laid the groundwork during the pre-approval process for some of the understandings of the basics. Granted, we're going to have to re-explain some of that stuff because nobody remembers that stuff from the first conversation, and that's okay. And I let my clients know right out of the gate, listen, I'm going to explain some stuff to you. If you forget, it's okay. Ask me a 7th, 8th, 9th time. It's okay. I don't get tired of explaining it. And if I didn't do this for a living, I wouldn't retain the knowledge either. But it's, say, okay, we're under contract based on this property, based on this price point, what are going to be our best options? What's going to meet those goals you have? So again, coming back to the client's preferences, their goals, their priorities, not just now, but in the future, figuring out which mortgage product is best going to fit their needs, be it a conforming, or conventional, government, FHA, VA loan, whatever it is. And then once we kind of establish from a product standpoint what the best vehicle is going to be, then it's a matter of going through the pricing and saying, okay, there's a common misnomer that every lender has a rate. I get phone calls all the time. Go, what's your rate? I go, I don't have a rate. And the reality is, for every rate, there's a corresponding price. And I won't go crazy granular into the details, but what you should be getting from a mortgage professional when you say, what's your rate? Or, what are my loan options? Should be options. It shouldn't be like, hey, the rate's 7%. That's not how it works. So it's a matter of not only choosing the product that's going to be appropriate, but also going through a few different scenarios, giving my feedback on, hey, here's the 3 options. Here's what I think about A, B, and C. Here's the one I recommend, but you tell me what you want to do and let me answer any questions you have.
Okay, that makes a lot of sense. From my understanding, the rates can change on a regular basis, right? So it makes sense to talk to you at the right time when they're looking to lock in their rate.
Yes.
Yeah.
Not only do you want to talk at the right time, but if you're talking to more than one mortgage person at the same time, get those quotes. I know this is going to sound crazy, but like within the same hour if you can. Oh, really? Okay. Because mortgage markets respond to what happens in the mortgage-backed security market, which is impacted by all the micro and macroeconomic factors, whatever's going on in the economy, what's happening with treasury securities, the stock market. There's a lot that impacts mortgage pricing on a minute-to-minute basis. So if you're comparing, say, 2 lenders, you want to make sure you don't have a quote from lender A from last Friday and a quote from lender B today. You won't be comparing apples to apples.
That makes sense. I tell my clients if they're shopping for rates to talk to a lender within the same day. And then look at the same product. So if you're looking at a 30-year fix, look at another 30-year fix instead of like a 15-year or even an adjustable rate mortgage. So let's maybe talk about rates and fixed rates and adjustable rate mortgages, because I think some people are confused by that. Can you tell us the difference between a fixed rate versus an ARM or adjustable rate mortgage?
Sure, yeah. So for the most part, a fixed rate mortgage is just what it sounds like. Somebody says it's a 30-year fixed mortgage. It means for the duration of that loan, that interest rate is fixed and is not subject to any kind of change. An adjustable rate mortgage, or as they're more appropriately called a hybrid mortgage, but everyone still just calls them ARMs, just because we've been doing it for decades. An ARM is actually going to have a period of time where it's fixed and it's not allowed to change. However, once that short introductory period ends, then the rate is subject to change based on whatever index it's based on. And again, without nerding out too hard on how that stuff works, the general idea is that if you're in an interest rate environment where rates are a little on the high side, sometimes people will favor one of those ARMs because it's going to give them a lower rate than a fixed rate. The problem we run into in some markets is that spread between the fixed rate products and the ARM products tends to vacillate quite a bit. So it's really about evaluating your options and making sure one is worth it. There's a lot of things to consider when it comes to, should I do a fixed or an adjustable? There's a lot to consider. As somebody who's been originating for 20 years and having done this through the financial crisis, you kind of develop a different system of looking at products and different programs. And ARMs are one of them where, if you ever ask me, what are your criteria to even think an ARM is a good idea, say for myself personally, equity position is really, really important. I think the less you're putting down, the more risky it is to look at an ARM. I think ARMs are great products for the right situation, but you've got to be careful. Financial stability, asset position. If somebody's well capitalized, they plan on being in a home, for a certain amount of time, and their income's stable, and they put a decent amount down, an ARM can be a really good idea. It can save you interest over whatever period of time you're looking at. However, if you're putting very, very little down, and there's uncertainty about how long you're going to be in that property, or your income is, unpredictable, like you're a mortgage broker or something like that, you work in real estate. If you don't have that level of predictability, an ARM might not be the best idea.
Yeah. I think an ARM makes sense in some situations like you discussed. I actually personally had an ARM on my house at one point in time, and it made sense for my family at the time. I know many families that decide to do ARM if they know they're going to be in the house only for a certain amount of time. Thanks for sharing that. So let's talk about some of the common issues you might encounter when you're going through getting a mortgage for a client.
Sure. So I do a lot of what you call rescue loans. Loans where somebody comes to me and says, Jason, I'm working with this client. We went somewhere else and it all fell apart and
That's fun.
that happens a lot. And I tell you what, of all the things that really kill loans, it ends up being income more often than not. And it's a matter of calculating income. And again, we come back to that, doing things right in the front end process, having that good solid pre-approval. One thing I like to do with my clients at every opportunity is do a fully underwritten pre-approval. This is where not only am I reviewing the documentation and I'm kind of pre-underwriting it, but I'm sending it into a living, breathing human underwriter who's the person who's going to say yes or no to that file to begin with. As loan officers, we don't have credit authority, and that's a common misconception. The person who's going to say yes or no to the loan is actually going to be the underwriter. So by sending that in the beginning, we can eliminate a lot of those problems, and income is the big one. I'll give you an example. If you have somebody who has variable income, that could be someone who's paid hourly, someone who has bonus income, overtime, commission, those types of income, you need a lot of data to calculate them correctly to do it the way the underwriter is going to do it. And W-2s and pay stubs don't give you all the information you need. There's actually a form we use in the industry called written verification of employment. And the name makes it sound like, oh, this is to verify so-and-so works here. And the reality is it's to get a solid breakdown for the last 2 or 3 years of how much of your pay was bonus versus overtime versus commission, and have a breakdown of that, because a W-2 doesn't break all that information down. It just says, here's how much you made, here's what you paid in taxes, and that's it. So that's an example of one way you can prevent some of those problems on the front end. Other problems I see kind of disintegrate a loan. When it comes to collateral, we see some property issues. A lot of times it's condo related, where there was something going on at the property that wasn't vetted out front. For instance, maybe somebody trying to do an FHA loan in a condo project that doesn't have FHA approval. We're trying to do a single unit approval in an FHA project, but maybe not having the things they need to meet it. There are a lot of things that go wrong if people don't do their due diligence on the front end.
Gotcha. Yeah, I know with like low owner occupancy, that can also be an issue for condo associations, right? Okay, so you mentioned underwriting. I think that's a word that a lot of people don't know. So can you explain to us, what does that mean, going through an underwriting process?
Great question. So underwriting is basically looking at a loan and saying, does this scenario meet the requirements? For example, if a program, say a conventional loan, requires a 620 credit score, does this borrower have the required minimum 620 credit score? Yes, they have a 635. Move on to the next thing. It's just looking at a loan and making sure that the requirements are being met. Occasionally there is, a judgment call or a gray area thing, but for the most part, they're all pretty straightforward things. It's making sure debt to income ratio is met, making sure any asset requirements are met, and vetting that the client has the cash to close and meet any, reserve requirements. And then, of course, you have your property, so your collateral requirements. Underwriting in a nutshell is just saying yes or no to the loan, and that's the underwriter's job. What a lot of people don't realize is that a lot of this takes place by a computer. There's something called an AUS, an automated underwriting system, that almost every loan is going to go through this part of the process, where we use a system called DU, or Desktop Underwriter. There are other ones, but this is the most popular. And basically, we put the loan through it, and this will kind of act as an AI and read the file and spit out a decision and say, as long as you put the correct data in here, yeah, this loan is eligible for this program. So when the underwriter gets the file, they're already seeing that we've run it through that underwriting system. So a big part of what the underwriter has to do is make sure the documentation we provided them to meet the loan's conditions are satisfactory. As an example, if somebody sends me a bank statement to prove they have assets, but it doesn't have their name on it, well, the underwriter is going to kick back and go, hey, I need a real bank statement with your name and account number on it, and have us reconditioned for it. So a lot of what the underwriter is going to do is not just make sure the program meets your guidelines, but also make sure that the documentation in the loan solidly proves and meets the requirements of the lender or the investor or whoever it is on the loan.
Okay, that makes sense. So it's like another layer of just checking everything, making sure everything is what people say it is.
It is, and that underwriter is the end all be all, where their yes or no is really what's going to say and go.
Okay. That makes sense. So another part of the process when you're buying property is getting an appraisal done. And I've heard some situations where appraisals have been waived.
Yes.
So, I mean, I guess, can you answer what an appraisal is? And then when would a property have a waived appraisal?
Sure. So appraisal is basically a way to document the condition, value, and situation with the collateral for the loan. Let's not forget, lenders are lending money based on this property's collateral. So this is a way for the lender to make sure this property is in livable condition, to have a solid, reputable opinion of the value. And that's really a big part of what the appraisal is. It's the appraiser's opinion of what that property is valued at. And they're going to base that on what comparable properties are or have sold for within that area. Now, generally, they want to keep that to the last 6 months, sometimes a little longer. They usually want to keep comparable sales within a mile or two radius when possible. It depends on if you're in an urban or suburban market or a rural market. But that's kind of the point of it, to make sure they have an accurate gauge of the property and its condition. What's great is every once in a while we get those situations where we get what we call a PIW, a property inspection waiver. We talked earlier about running things through that DU, that automated underwriting system. That's where we find out if we get it. When we run it through, it'll tell us every once in a while, hey, this scenario is eligible for a property inspection waiver, which means we don't need to do an appraisal.
Okay.
There's no, Fannie Mae, unfortunately, has been very slick about not sending out a list of saying these are the criteria for the system to generate one. So we don't know what they are, but on a purchase transaction, usually you're going to need at least 20% down to generate one of these. But again, those guidelines are shifting all the time. And there's no real recipe that they've put publicly facing to show us, but it usually does have to be a pretty vanilla, pretty low risk scenario to get one of those.
Okay. What are some ways people can prepare to finances before they start looking to buy a house so they could be in a better position when they get their mortgage?
That's a great question. And the first thing I'll say is videos like you're watching right now are a great resource and they're a great help. But talk to somebody. Talk to a mortgage professional. I can't count how many times I come across a client who I get introduced to and they're like, oh, I need to raise my credit score before I can talk to a mortgage person. I said, how do you know that? Like, oh, I watched Barbara Corcoran on some show. I'm like, whoa. She's not a licensed mortgage originator. You're wrong. She's a beast at real estate, but she's not a mortgage professional. Talk to a mortgage professional, let them run your numbers and kind of figure out what's what. That's definitely one thing I will say. But in terms of preparing, have your own idea on what you're comfortable with. I see all too many times where a client comes to me and they're like, hey, what can I afford? And they're waiting for me to tell them what they can afford. And don't get me wrong, that figure is important and it's part of my job to give that, and I'm happy to. But for me, I want a client to have an understanding of what they're comfortable with. So if I were buying a home for the first time, one of the things I'd want to figure out is I'd kind of lay out all my bills, I'd look at my budget, and if I didn't have a budget, I'd make a budget. Because when you go from renting to owning, life changes. You got hot water heaters and landscapers and just stuff you never thought you'd deal with in your life. Owning a home is awesome, but it does come with its share of added responsibility, and budgeting, I think, is one of those that are critical. So I would have a good idea of your budget and just know your finances. They don't necessarily have to do anything with their finances, but know them. Again, I run into a lot of clients who it's like, I ask them, like, hey, tell me about your assets. How much do you have in the bank right now? Well, I don't know. So, hold on a second. We got to know. You don't need to know everything down to the decimal, but have a reasonable idea of how much you have in cash assets, what your non-cash assets are, how much is in your 401k, things of that nature. Just have an idea on where you stand financially. It's a simple matter of just reviewing your own existing situation. Know what your current outstanding liabilities are. I know in this world, everyone's always trying to shove a credit card in your face and get you to take on another one. So it's easy to lose track, but by having a budget or at least some kind of tally of what your outstanding liabilities are can help you, for one, to come up with a realistic figure of what you feel you're going to be comfortable paying per month, but also make your consultation with a mortgage professional a lot easier because you're going to have the answers to the questions right away.
Yeah. Okay. That makes sense, Jason. So you're suggesting that a buyer, somebody looking to purchase a house, kind of figure out what their monthly budget is in a house.
Yep.
Whether that's like $3,000, $5,000, $10,000, whatever it is per month.
Yeah.
And then what about down payment? Like, how much should they save for a down payment?
That's another question I get a lot. And here's the thing, there's no number. I've done loans for people who had no down payment. You know what I mean? So it's a matter of seeing how all the pieces come together. Buying a home and putting together mortgage financing, it's just an equation, right? And we have different variables that we can move around. So if the client says, hey, I want a $3,000 a month payment with everything included, but they've got $2,000 to put down, you go, okay, well, we got to move that up if we want to have this payment for this price house. And we just start moving variables around until we get somewhere that makes sense. I know a lot of people, have the idea in their head that either A, I need to put 20% down to buy a house, which you definitely don't. Or two, that, I don't want to buy a house with less than 20% down because I don't want to pay PMI.
Talk about that. PMI, what is that?
PMI is awesome. You never hear somebody say this. PMI is awesome. Here's why PMI is awesome. Because if it weren't for PMI, people with less than 20% would not be able to buy a home with a conventional mortgage.
Okay. So
plain and simple.
You're the first lender to tell me that PMI is awesome.
Yeah.
Tell me.
Probably the last.
It's a private mortgage insurance, right? So
yes.
Anything that's under 20% down would require PMI?
With a conventional mortgage, mortgage. And that's generally speaking too. It's mortgages full of caveats and if this, if that. Yep. But generally speaking, yes. And here's the thing. Once upon a time, people bought houses with 20% down pretty commonly. Houses cost, $8,000 or $80,000 or $60,000. As the price of real estate went up and up and up, it got to a point where 20% down payments were a lot harder to come by. And banks said, hey, listen, we have credit-worthy people out there who can afford a house that just can't save up for this down payment. How do we get them into houses? And that was kind of the genesis of PMI, where it came from. So PMI is basically a lender is comfortable lending up to 80% of the value of a property.
Okay. That's
where they're comfortable. And if you got 10% down, that means they're 10% uncomfortable.
Yeah.
It's because that's the other 10% to make up 100%. And the insurance company comes in and says, okay, well, we'll insure this 10% that you're uncomfortable lender, and we can make the borrower pay the premium. I know it sounds terrible and evil, but it's a lot better than not getting a house because you don't have the down payment. So personally, I think PMI is a means to an end as far as the worst way you categorize it. To me, I just choose to look at it. It's a way to purchase a home when you don't have 20% down.
Okay.
And people tend to look at this as this shackle, but PMI on a conventional mortgage goes away after a certain point in time. You don't have it forever. I bought my first home, had mortgage insurance, and I don't have it anymore. Just because of the process I went through, the property appreciated, and I was able to get rid of it at a certain point.
Okay.
And it's a very common journey for a home buyer to start in a product that has either PMI or a mortgage insurance premium, and gradually over time, as they build equity, as they build that equity through appreciation and paying down the principal balance or a combination of the two, they end up getting to a place where that PMI can be removed. If it's a conventional loan, if they have a FHA or a government loan that has a mortgage insurance premium, which is a little bit different, they often will refinance into a conventional loan without mortgage insurance, so PMI.
Gotcha. Okay, makes sense. And then, lately I've been hearing a lot of people talk about buying down the rate, right? Or paying points. That's a little different, right?
Yeah.
So why don't we talk about a little bit about that?
Yeah, buy downs are a great tool for the right situation. As you probably get a taste from this conversation, everything in real estate, especially mortgage financing, is very situational. It's about tailoring to the situation. And buy downs are no different. So what a buy down is an option to do is, let's say a buyer comes in and they say, hey, Jason, I've got a 740 credit score, great debt to income ratio, I can put 20% down. What's my rate going to be? And I say to that client, hypothetically speaking, 7% with a 7.125 APR, whatever it is. So 7% my note rate. Okay, great. The client says, well, I really want a lower rate than that. I needed my payment to be below this threshold. How can I get it below this? And I can say, well, listen, I can give you a rate of 6.75, but I still need to offset that risk that was built into that interest rate. So the way I can do it, instead of giving you a 7% interest rate, you can pay 1 point.
Okay.
1 point is 1% of the loan amount. So if we're doing a $500,000 loan, there's $5,000 that person would pay in points. And the idea is how you measure if it makes sense to pay a point, at least mathematically speaking, is usually just saying, okay, well, what's the difference in my payment? If my payment's going to be $75 less if I pay a point, how long is it going to take me to recoup that investment of the 5,000 points I pay to get that?
Yep.
And generally, you want to see a quicker return than a longer return on that. In this market, it's very, very hard to see an advantage to paying points right now.
Mm-hmm.
And the reason is that on an economic level, none of us have crystal balls, but a lot of signs are pointing to rates coming down in the near future. So if they do, it casts a lot of doubt that you're ever going to recoup the investment from paying points. So it's, for strictly mathematical reasons, it's not always advantageous to say, or it's not often advantageous in this market to pay points. However, there's more than just math at play when you're putting a mortgage together, which I know sounds, counterintuitive, but sometimes it can just be a matter of home is either going to be affordable to me or not affordable to me, and paying points might actually cross that line between affordability and non-affordability.
Gotcha.
So sometimes it's a philosophical or a psychological difference. But right now, from a mathematical standpoint, points aren't real popular right now.
Okay, sure that you thought interest rates might be coming down, but
yeah, it's tough to say. There's a lot at play economically speaking right now. Interest rates were supposed to be lower already, like 6 months ago. And it didn't really play out that way. A lot of it's had to do with what's going on in the banking sector. And, inflation's not the only force driving mortgage rates. It's one of the more dominant forces. But government debt, the amount of bonds being issued, there's so many other factors that affect where mortgage rates are. And, the big thing, I think, is the Federal Reserve is still seeing the economy for a bit healthier than I think all of us in the trenches really feel like it is, specifically from an employment standpoint. Despite inflation coming down and despite things going the way they have in the last 6 months, employment market, the numbers wise, has looked really good when reports come out. You keep seeing these ADP and BLS, I should say. Their job reports come out and they're like, yeah, we beat expectations, 300,000 new jobs created. And then a week later, that number gets revised down 75,000. Oh. But, the report that beats expectations is on page 1 of the paper, and the revision where it says, oh, we only created like 50,000 jobs, that's buried on page 7, and investors aren't even seeing it.
Okay. Yeah. So I've always been curious about that, like interest rates. How is that factored in? You just said it's a bunch of different factors that play into the mortgage rates.
There's a ton. Inflation's a big one, obviously, because a mortgage is essentially it's a bond. It's like investing in a bond, and you're looking at the lifetime value of that. And as markets move up and down, the value of that bond vacillates up and down. So where inflation stands is definitely going to have a big impact on mortgage rates. Higher inflation, higher mortgage rates, and vice versa. You're going to have government policy. When there's a lot of government debt, you're going to have a lot of bonds being issued. So if there's more bonds out there to be purchased, you're going to have less of an appetite for bonds.
Gotcha.
How do you whet an appetite? Higher yields, higher rates. So there's a lot of factors that really impact everything. And right now we're in a unfortunate kind of perfect storm of a lot of those factors are working against us right now. Yeah. Again, I think the road ahead looks a lot better, and there's definitely light at the end of the tunnel. I don't think there's 2 or 3% light at the end of the tunnel, but
that's crazy.
I think 5 or 6 light is there at some point in the near future, hopefully.
Yeah. I mean, isn't the average rates, like around 7%? Like if you look at long term, like where we were before was very, very low. I
mean, they've moved up. They're definitely north of, the average rate is definitely north of 7. There's different indexes you can use to kind of measure that. And again, your government products are generally going to price a little bit lower than your conventional products. So it really depends on kind of what product you're kind of focusing in on to see where rates are at.
All right. Well, thanks, Jason. Thanks for coming out and sharing your expertise with everybody.
Absolutely.